Hi, everyone. Thanks for joining us tonight. I think we're expecting some more to trickle in, but for the sake of time, since we only have an hour tonight, I'm going to get us started. It's nice to see you. Let me see. Okay, there we go. I'm Ali Matroni. I've met many of you, but for those of you I haven't met, I'm an impact advisor at Align, and I will be facilitating our conversation tonight, or I guess today if you're in Pacific time. For those of you who aren't familiar with Align's work, I'll just give a quick overview. We're an impact investing advisory firm, and we work with families, foundations, and institutions to help them align their investment portfolios with their values. So we look at opportunities across asset classes, impact sectors, and geographies. And we meet our clients where they're at, whether that's helping them to invest a carve out of their portfolio into private markets, or whether that's playing full wealth manager, portfolio strategists, and fully managing their portfolios. Our team was very specifically crafted with people from all over the world, which is particularly relevant for our conversation tonight. Collectively, we speak 14 languages, have lived in 20 plus countries, and come from places like Blackstone, JP Morgan, the United Nations, the World Bank, and the Peace Corps. And we all joined Align with strong conviction in the power of engaging private capital to change the world. Speaking of, Jihana, a member of our research team, and Raima, a colleague on our advisory team, are going to be guiding the first piece of our conversation tonight. They'll start by walking through a framework on how we think about impact investing in emerging markets, and then we'll move into a panel discussion with some practitioners that you'll see on the call. I would love for you guys, Raima and Jihana, if you don't mind, to maybe give a quick 30-second spotlight to start on why investing in emerging markets is important to you personally, and then feel free to kick us off with the content.
Amazing. Thank you all for joining us. And thank you, Ali, for that introduction. I would say I'm personally passionate about investing in emerging markets because my family moved to the US when I was 6 from Pakistan. And so, of course, being from an emerging markets country, I'm really passionate about investor capital being invested in emerging markets. But then as we think about Align and our mission, the goal is for the world and the planet to work for all 7.8 billion people, and recognizing that 85% of people on the planet, which is 6 billion people, live in emerging markets. And so in order to accomplish our own mission as an organization and for our clients as well, recognizing that such a significant amount of that is within emerging markets. Jihana?
Thanks, Raima. I'm similarly very passionate about investing in emerging markets, and that's primarily because I've spent a good chunk of my life living in these countries and experiencing firsthand the immense challenges so many of our fellow humans face. I started my international development work living in Papua New Guinea, where I was working on HIV/AIDS policy. I was then a Peace Corps volunteer in Paraguay, working on public health and democracy building, and then lived in Panama, working with 3 Central American countries on their malaria programming. And in all of these incredible experiences, I was constantly humbled by the ingenuity and the resilience of those around me. But I was also gripped by the moral responsibility of recognizing that we are all have this shared humanity, and we have an opportunity to support one another. So I'm really excited to be here with all of you and have this conversation.
Great. Do you guys want to kick us off?
Yeah, absolutely. So like Ali mentioned, the initial part of this conversation is just going to be providing an overview and investing in emerging markets, and then we'll be handing it off to our panelists. And so to start off, one of the frameworks that we initially wanted to establish was just thinking through the history of investing in emerging markets. We think it's important to set the stage with that context. Can everyone see Jihana's screen? Okay, perfect. So as we think about investing in emerging markets, often what people think of is the creation of development finance institutions, which were specifically after World War II and thinking about reconstruction of emerging markets. And this was established as part of the Bretton Woods Agreement in July 1944. This was through the International Monetary Fund and the World Bank's creation, and it set the precedent for other development finance institutions to take root as well. But when investing in emerging markets became more mainstream was during the 1970s as part of microfinance. Dr. Muhammad Yunus recognized that financial inclusion is an important lever in order to have the ability for individuals to uplift themselves out of poverty, and started the Grameen Bank in Bangladesh, recognizing that microcredit is not available to individuals who live in rural areas and those especially who are low income and often women in emerging markets. And so that's when the term of microfinance became much more of a mainstream concept. But impact investing itself was coined in 2007 as part of the Bellagio Center meeting hosted by the Rockefeller Foundation. And it was there that we established the true definition of what impact investing truly is. And that's that investing with the goal of generating positive, measurable social and/or environmental impact alongside a financial return. And as we all know, impact investing has boomed since then, and the current market size of impact investments is $715 billion. And as we think about investing in emerging markets today, the Global Impact Investing Network, or the GIN, has conducted a survey in 2020, which they do on an annual basis. And according to their survey, 55% of AUM is allocated to developed markets and 40% is allocated to emerging markets. But as we mentioned earlier, 85% of people on the planet live in emerging markets. And as we think about this data, we also recognize that this includes institutional investors and those who are across the globe. And we recognize that this figure of investment capital into emerging markets would likely be much lower for US-based investors and foundations. So I'm going to turn it now to Jihana to just walk through the perceptions and realities of investing in emerging markets, because we recognize as we are going through this presentation that there are tangible risks of investing in emerging markets, and we want to ensure that you all have a lion's take on thinking through each of those.
Awesome. Thanks, Raima, for teeing that up. Indeed, as Raima said, in part stemming from some of those controversies in microfinance, but also limited exposure to emerging markets, some investors have developed perceptions about what it means to invest in emerging markets. And it is true that some of those perceived risks are real, and we at Align are very proactive in finding ways to mitigate emerging market specific risk. But some of those aspects of those perceptions have been inflated. So we felt it would be helpful to walk through them here. First, there's a perception that market returns are not viable in emerging markets. If we look at data from PitchBook, aggregating thousands of funds over 11 vintage years, we can see that while it's true that emerging markets are somewhat underperforming the rest of the world, it's by a very small amount, median of 14% versus 15% across asset classes. So market rate returns are viable in emerging markets. Like OECD, investing emerging market impact funds, some will target market rate returns and some will intentionally target catalytic risk return profiles in order to generate outsized impact. And for us, we underwrite both types of strategies. So it's really just a matter of an investor choosing what risk return profile they seek. Another chief concern is that of foreign exchange. And again, it's a real risk. We certainly have had certain strategies temporarily negatively impacted by foreign exchange. But it's also important to recognize that this does not only apply to emerging markets. In fact, I actually learned this from Joanna's colleague, Ami. The euro depreciated more in the last year than the rupee, rupiah, or peso. One mitigating tactic here is to hedge against foreign exchange risk, but that the cost of that needs to be outweighed against the benefits. So some of our funds do employ a full hedging policy for their whole portfolios. Some do partial, some do none. And for us, it's our job to make sure that the appropriate hedging policy is selected for any given strategy. As we've alluded to, the microfinance industry became known for predatory lending, where end borrowers were charged exorbitant interest rates. And what we've seen today is that there is still indeed predatory lending, and that's part of our work to screen out those bad actors as part of our impact diligence. And we do that through looking at interest rate caps and borrower protection clauses. That said, we also do recognize that interest rates are higher, inherently higher in emerging markets because of the short tenors or the high cost of loan collection, particularly for non-digitized populations, lack of collateral, etc. So some strategies need to be adapted to the local context. And lastly, some investors are rightfully concerned about geopolitical dynamics. That said, investors can and are selective. The funds on our platform carefully pick their target countries by using the IFC exclusion list, World Bank doing business scores, Bloomberg resources, and so forth. And the other mitigating tactic here is, or aspect, is that many private funds have terms of 7 to 12 years, so they can outride any short-term instability. So I'd say the takeaway here is that of the perceived risks in emerging markets, some of it is exaggerated, but some of it is real. And for the real risk, we do have tactics to make sure that the investments that we select are gearing towards the financial and impact performance sought. Speaking of impact, I'd like to share some stats on the condition of us, humanity, today in 2022. And this is not designed as a us versus them, it's more the collective state of where we are and the opportunity to bring us all up to, frankly, just livable conditions. Starting with climate, climate is not just an environmental problem, it's a people problem, as all of you here know. Of the top 10 cities that are most vulnerable to climate change-induced flooding, 9 of those are in emerging markets. That includes Mumbai, Dhaka, Bangkok, Ho Chi Minh City, and more. And to Raima's point of coming from Pakistan, the flooding there is unfortunately just a precursor for what is expected to come. For anybody interested, the 10th city in OECD countries is Miami, and we are also already seeing the effects of that, unfortunately. In most developing countries, there is no government social net. The concept of a homeless shelter or welfare benefits or retirement support simply doesn't exist. I experienced this firsthand with my neighbors in Paraguay, where the poor literally have no backstop, and can attest to, yeah, poverty looks and feels very different when there's no floor. Water is another area of high need, since 80% of illnesses are due to water and sanitation, and 1 in 4 people don't have access to a toilet. In a small anecdote here, in Papua New Guinea, I was one of those without access to a toilet, which became particularly challenging when I got malaria and my bowel movements went nuts. I will save you from all the further details, but trust me to say, I really learned the value of having a toilet. And I think it's important to internalize of this group of us here, if there's 20 of us, at least when I started sharing screen, 5 of us would not have access to a toilet. So that's really a large number. And 10% of us wouldn't have access to water, which is one of the most basic requirements for life. Water was also very relevant for me in Paraguay, where for 4 months of drought, I didn't have access to water. And I remember every morning I would wake up and pray to see a cloud in hopes of coming rain. We'll share one of our investments that focuses directly on this challenge. Financial inclusion, the lack of financial inclusion is a problem in both developed and developing countries. That is why we underwrite so many CDFIs and financial inclusion funds here in the US. And in emerging markets, it's actually a really exciting time to be working on this, because the very quick spread of cell phones has unlocked a ton of opportunities for helping otherwise disconnected populations access financial services. And it's possible maybe Joanna from Elevar can share more on this. I think some of their work touches on that. Lastly, maternal mortality. Per birth, a woman in Nigeria is 200 times more likely to die than a woman in Sweden. And the injustice of this is that the vast majority of that is completely preventable. We also have some grants and investments that are working on this topic. Without further ado, I will pass it to Raima, back to Raima, who can share what the investment landscape looks like to address these challenges.
Thank you, Chihana. So as we were preparing for this presentation, one of the things that we really wanted to hone in on was actually understanding what is the investment need on an annual basis for us to achieve the 2030 UN Sustainable Development Goals, and also to isolate of that, how much is needed in emerging markets. And so the United Nations Environmental Program created a report a few years ago. And I recognize this chart can be a little bit confusing, so I'm going to try my best to disentangle it. If we're thinking about investment need, those are the blue columns, and I'd focus on the first two. Advanced countries represent $1.5 trillion of investment need, whereas emerging markets and developing countries represent $4.5 trillion of need. So advanced countries represent 25% of that, and emerging markets represent 75% of that. But if we think about the actual financing gap, taking into account the black and the orange bars, the public flows and the private flows, you can actually see within advanced countries, the financing gap to achieve the UN Sustainable Development Goals is 0.1 trillion, whereas the financing gap in emerging markets is 2.5 trillion. And that is a result of the lack of flows in public and private capital. And Africa specifically was included as a highlight because $1.3 trillion is needed on an annual basis up until 2030 to achieve parity when it comes to the Sustainable Development Goals. And so as we think about investment capital and the ability for your dollar to go even further, that's why we wanted to highlight specifically what is not just the investment need, but the financing gap between what is currently available in public and private inflows. I'll now pass it back to Chihana to just walk through a few different investment examples across asset classes and impact themes.
Cool, thanks, Raima, playing ping pong. There's many ways to fill that financing gap. And the good news is that there is a flavor of emerging market investing for every investor taste. Investors can select investments by SDG or impact category, from clean energy to conservation, ag, financial inclusion, gender justice, you name it. And for each of those impact categories, there are opportunities in nearly every asset class, from VC to debt to real assets. You can even use other parts of your portfolio, like philanthropy and public equity, to advance your emerging markets portfolio. One can also select by risk return profile. Some of these are catalytic, some of these are market rate. And by the way, these are descriptions, but they're all real investments and grants that Align has already approved or is in conversation with. And we would be more than happy to share more about them in a follow-up conversation. Raima is going to deep dive into some of these for us.
Yep. Thank you, Chihana. We will quickly walk through 4 different example investment opportunities, and our intention here was to have a diversity of impact themes that each of these are targeting, but then also, like Chihana mentioned, asset class diversification and also a diversification of those that target market rate returns or those that target impact first returns. So the first example that we wanted to share was Spark Meter, which is addressing poor grid reliability in emerging markets, and it's specifically focused on clean energy and resource efficiency. 3.5 billion people live without reliable electricity access. And if you think about what that actually means on a day-to-day basis, that affects a student's ability to be able to complete homework, because once sunset happens, there is no sunlight for them to be able to actually turn to their textbooks. That affects your ability to have refrigerated or frozen food, your ability to cook. And so the actual access to electricity has so many other ripple effects when it comes to their general livelihoods. And in emerging markets, oftentimes people rely on back backup generators, which are using diesel and are much more harmful for the environment. So the Spark Meter was a direct investment opportunity that our clients were able to participate in order to achieve clean energy and resource efficiency in emerging markets. The next that we wanted to turn to was water equity, which is the only asset manager that is fully focused on access to water and sanitation. It's an impact-first investment, and they aim to address the global water and sanitation crisis that Gihanna walked through earlier by providing debt capital to financial institutions in emerging markets that allow them to scale their water and sanitation lending activities. The next one is Lendable, which is specifically focused on financial inclusion. And like Gihanna mentioned earlier as well, 2 billion people do not have access to credit, and it truly is a lever for which individuals are able to uplift themselves out of poverty. And the last one, which is a good transition to Joanna, is Elevar, which is specifically focused on providing essential products and services such as financial services, education, housing to underserved customers in low-income communities in India and Latin America. And so now we will turn it back to Ali to introduce our panelists, but we hope this was a helpful context and foundation setting for investing in emerging markets.
Awesome, thank you guys so much. We are excited to transition now to our panel featuring 3 people who experience emerging markets investing from all different vantage points. Joanna Posada, founder and managing partner at Elevar, who we're super excited to have with us. Ami had a family engagement come up, and Joanna was super gracious to join the discussion tonight. Robert Kim, managing director at J Lin, which is Jeremy Lin's family office, and Juan Diego Gomez, CEO and founder at Sun Colombia. I know we've talked about this with you 3, but for the audience's sake, these 3 panelists have so much to contribute to this discussion, and each one could probably have their own talk show on emerging markets investing. So for the sake of time tonight, we are asking them to keep their answers relatively concise. And then when we open up to audience questions, we can double click on any of the sound bites that are most exciting or most challenging to people on the call. So let's kick it off with each of you giving us a glimpse into your world. And for fun, why don't you share with the participants on the call where you are geographically during this call, because you're all over the world. Joanna, why don't you start by sharing, maybe in brief, what is Elevar's investment strategy and what is your role there?
Let me unmute myself. Well, first of all, thank you for the invitation of being here. It truly is an honor. So I'm originally from Mexico. I'm actually sitting in Seattle, but I was born and raised in Mexico. I'm co-founder and managing partner at Elevar Equity. And it was a great introduction to Elevar. Thank you for highlighting it. We're an early stage and growth equity impact manager, and we've been around since 2006. So definitely before the term impact investing was even coined. And so we started with microfinance and have evolved our thesis and our investing since then. Today, we manage about 5 funds. We've raised about 400 million in capital and have invested in 45 companies that are providing basically essential services to these underserved customers across India and some countries in Latin America. With respect to our investment strategy, I'll be brief here, but basically I view it with, across 2 pillars. So the first pillar is client centricity. So since 2006 and even now, we spend a lot of time on the field in the countries and the markets that we invest in. And we go to the field and we really have seen and are advocates of the economic resilience and the vibrancy that we see in those low-income communities and this underserved customers. And so we really spend time there to identify the pent-up demand and how they're allocating their wallet share. And once we have that and we have a thesis, then we really fuel these customers and these communities by investing early growth capital into execution-oriented entrepreneurs, because the entrepreneurs are key to our investing. And they basically are investing at the intersection of 3 things. 1 is inclusivity. So again, we're talking about essential services. 2 is affordability. And I think I'll speak a lot about this because I think this is key, right? Given our target customer, the innovation will always be in how do you distribute, how do you reach these customers with affordable prices? And we believe that if you do that with quality, then the third component has to be massive scale. And we do operate in very large countries, right? Where there's a huge need. And I mean, if you think about just the lion's share of the population, as you were mentioning, is really with this underserved customers. So if you can, reach them with the right product, the right price, then they're very loyal customers. And we've seen that you can scale with that and you can be, build a sustainable company with that. So I'll stop there just to let the other people go.
One quick follow-up question, just as a
Sure.
kind of natural line from that. What is the impact potential of investing $1 in emerging markets versus in other markets from your perspective?
Yeah, I mean, I'll give you a very short response here in terms of our results. So we, again, we're actually raising Fund 5 in India, but up to date about $400 million, but we've invested about $220 million. And with that, we've catalyzed about $2.2 billion of additional equity that have come in after we've invested. This has fueled the growth of the companies. And that has reached, so our companies that are serving these customers with essential products have reached about 45 million households, not individual, but households. So you can multiply that by 4 to 5, whatever you think of household is. So that's 45 million households reached with about $220 million. So for every $4.8 we've invested, we've impacted a household. So that's the potential, and we can talk about macro stats and in these countries, but that's what we've achieved so far.
That's amazing. Juan Diego, let's kick it over to you. Can you give us a quick overview of what Fund Colombia does, and maybe just describe what the main products in your portfolio are?
Okay, so Sunco is a digital, decentralized, vertically integrated utility. It's a company I started 10 years ago with a single journey of going from the off-grid, offline, low-income world into the on-grid, online, high-income world. In all that, I somehow develop a bunch of products, mainly based in resilient power. And that means that the ability we created in the off-grid, offline world will give us low cost in the online on-grid world. With all that together, we are a kind of holding company right now with more than 8 companies below. We have from IoT innovations, smart metering innovation, doing production. We have a construction solar company itself. We have 2 digital utilities providing service in the country. And we are doing software as a service for utilities, doing digital wallets for them and bringing them through energy, the financial inclusion. And probably the best thing we've done is we became the one-stop shop for the utilities. So whenever they need to invest in shared value initiatives, we develop a bunch of products like energy hubs, libraries with power plants, water hubs, that they are given to the community as a CapEx investment. We do the operation and we charge for both, for the CapEx and then for the operation itself. So that made us a sustainable and profitable company for the last 10 years in Colombia. And now in our Series B, we're opening more countries, mainly Caribbean, to bring these resilient power technologies up to the rest of Latin and Central America.
You almost teed me up for what I was going to ask as a follow-up question to that. Can you tell us a little bit about what the fundraising journey has looked like so far for you? What's been easy? What's been hard?
My journey is a little bit weird because we were not looking for funds and we were not ready for them. And 3 years ago, it came an impact fund, and they just help us like build our impact thesis, because we had it in our DNA, but it was not as a thesis for the company. And for 3 years, they helped us do that and really identify the most profitable products out of the impact. And that made us open our Series B just 4 months ago. We were awarded a company that impacted the most of the SDGs for UNDP, and that made us get the SDG standard certification, which is like the next level of B Corp. And with the Series B went very fine with other investors coming in, seeing that it was happening. So right now we have 2 banks in the Series B and 2 funds, impact funds, one American impact fund already.
Awesome. Yeah, thanks for sharing that. Robert, let's come over to you. Can you tell us a bit about your impact investing journey and how it led you to your current role? We've known each other for a little while, and I find your journey so fascinating that brought you to where you are now.
Yeah, well, thanks for the invitation, first of all. So my journey has been, I've been in the impact investing space for about 13 years now, and initially as a venture investor, then moved over to multifamily office, and then moved into a single family office starting this year. And so I've done a little bit of direct investing on the early stage side. Then on the multifamily office side, I work with families and endowments to help them move a lot of their, or manage the entirety of their balance sheets. And many of them were very passionate about impact. And so I was in a very privileged position to, in a very small team, help deploy over $1 billion into impact over the last 10 years across asset classes. And but something still was kind of missing personally. I kind of felt like we were making a decision at sort of like a quote unquote corner office in our sort of comfortable home. I was in Palo Alto, and even though we were doing amazing work in terms of elevating the field and scaling and then et cetera, I personally kind of felt like I wanted to see sort of underground impact and help some of these founders really, go further in their mission. And the fact that I was managing several family offices and playing a CIO role and managing risk across all asset classes, it just didn't allow me to do that. And so, long story short, Jeremy Lin was one of the families I work with, and then I decided to join internally so that he and I can go a little bit deeper into creating impact. And so what does that mean? We're figuring it out, but we've always had a passion for emerging market Asia in particular. And when we look at just the GDP per capita there, when we look at the quality that is sort of hidden under the perception of quote unquote risk, we get really excited about impact and financial opportunity there. And so I decided to actually move to Asia 5 months ago, just to be a little bit closer to this part of the world. And we look to invest directly into founders. Also, we found that mental health is a huge issue for them as they try to scale these businesses and as try to help the communities. And so we're going to really lean into helping them from a mental health perspective post-investments. We also realize that we're a small team, and so we want to invest into first-time high-impact GPs, and not just as an LP, but really get involved as a venture partner and spend a considerable amount of our time. And as a result of that, we will also get a carry share as well. And so, because we realize we have to help the change makers who can also serve, and so that's kind of going to be our strategy. And so we're very excited. I think. It's only been 9-10 months in, but I feel like impact investing is not just about checking the box, right? It's much more about it's much more about relationship. It's much more about proximity, to really understand that your capital is actually going toward the issues that you care about in a way that you want it to. And I think being close to the ground is going to be very, very important. And I've actually just learned so much in the last 9 months compared to what I did over the last 10. And so, it's been a privileged position, and really loving every minute of it.
That's so awesome. And I love the focus on mental health of founders post-investment. That's super important and only getting more important. In the last 9-10 months you've been on the ground in Asia, what are some themes that have emerged for you, investment themes, things that you're excited about strategically?
Yeah, I think education financing actually is very exciting for us. We care a lot about access, actually, as a family office, access to basic services like education, financial services, healthcare. And we found, everybody thinks that a lot of people, and I did too, honestly, that student credit. Student credit in the US, like default is like 10%, so very risky. So I thought in emerging markets would be a lot higher. It turns out that we found a company that underwrites loans to students in low to moderate income households in Philippines and Indonesia. And their default rate in Indonesia is less than 2%. And then in Philippines is a little bit, is around 5.5%. And so the fact that they were able to underwrite a loan and structure and share the risk with the schools as partners, and was able to achieve the IR that they were able to while giving these students opportunities who otherwise couldn't have gone to school, is fascinating to me. It's really fascinating. So I think that's kind of what I've learned is being close enough, you care enough, you look deeper enough, and there's really quality here. So that's what I've really appreciated the most so far.
That's awesome. Joanna, back to you for another question. I have worked with people throughout the last few years, and people within my network and friend group who may feel a certain pull to certain parts of the world, or they might think, I'm really drawn to Africa because I see the opportunity there, or I feel connected to people there for some reason. How would you position, Elevar used to invest in multiple geographies out of a single fund and now has funds for each geography. How would you talk to someone who maybe doesn't feel like they have a personal connection to India or Latin America about investing in an Elevar fund that's focused specifically on one of those geographies?
Yeah, I mean, again, I think, as you said, impact investing, when you think about 86% of the world and emerging markets, whether you're working in Africa or India or, Latin America, I think, again, there's a need to ensure that there's more capital flowing into this geographies. Right, in Elevar, we do have, again, I'm from Mexico, my partners are from India, but it really is, when you're in the ground, whether you're in Latin America, you're in India, you're in Africa, and you think about the customers and the people you're impacting, they really are very similar. Their needs are similar, their obstacles are similar, their ambitions are similar, right? So, part of it is just that understanding on the ground, and really, spending time with the clients and seeing, the amazing potential and opportunity that it's there. Having said that, again, besides a personal connection, I think that there is a lot of opportunity in emerging markets, right? And my first commentary here is just the scale and the growth of the companies and the markets that we invest in, right? And this is really driven, again, by the underserved nature of the customers. And the second commentary in terms of just, when you think about this market, is having a long-term perspective, like the impact and the returns you can have if you're investing in these geographies from a long-term perspective. So it's now not a one-year lens. It really is, a 10-year cycle where, yes, you may go through different crises. And at Elevar, we have navigated many of these crises, and yet, you can come out and have the impact and actually deliver upper quartile returns. So it's not only that you need the personal connection, but again, there's a huge opportunity here. Some stats, and I'll be fast here, just from a macro perspective: 1.5 billion people in India, fifth largest economy, actually overpassed UK in 2022, will be the third by 2030. GDP grows at about 6%, but 60% of the population is underserved. So that's about 10% of the entire world population, right? And it's a very deep capital-driven market. So there's about 20 billion deployed across 940 startups just in the first half of this year. And you have similar stats for, say, Latin America, where you have 600 million population, right? Not including Brazil, and about 40 to 60% face income inequality. And that's a very top-down approach. And from a very bottoms approach, kind of saying, if you really are close to the customer, you have that farmer, right? That suddenly, gets connected via, say, one of our companies, Amunati, to a market where they can actually have higher margins, or an SME that is unable to kind of sell online and via Nuvem Shop, which is an investment of Velivar, is able to have an end-to-end solution and increase their 40% their income just by having access to a solution that really allows them to open up their sales. And so those are the stories that we hear and that really drive us to invest here, and that should invest anyone, drive anyone that wants to invest and wants to make a difference in the world.
I love Velivar's commitment to the bottom-up customer-centric approach. I've heard you use that language a lot, and it seems to really fill in across your strategies. One other quick question for you. You previously worked in microfinance, and Raima and Johanna mentioned at the beginning of their framework, kind of some of the historical relationship for investors to microfinance and some concerns around predatory lending. How do you ensure that investments are empowering end beneficiaries and not crippling them through predatory lending or through terms that aren't fair to entrepreneurs taking them on?
No, absolutely. And I think, in the 15 years or so that we've been around, we've actually developed a framework, EM framework, to basically address those things. And I think at the heart of it is really affordability. We invest only in companies that are targeting and are really tailored to that customer segment. So they're not subsidizing, it truly is looking at that customer and their needs. And two, again, it has to be an affordable product. And so in an equation of revenue, we are looking for low margins. We're minimizing the P part of it, but we're trying to maximize the Q, which is scale. Right. And so you build good companies. And so in that sense, you really are very aligned in terms of impact and financial returns. They have to go hand in hand. There shouldn't be a conflict there. And the other thing I will say, because we were in microfinance and we did go through that whole thing. One is, again, stay close to the client, understand what's going on. So we actually were in India and we're talking to clients, and they were saying, oh, we have 5 loans. And we're like, what? Right? So we actually divested from a company when we kind of are seeing those things. And two, again, if you're building the DNA of impact from the beginning, you're also building governance. And so that, I think, is also key, right? Being part of the boards, being the voice of the client, and just making sure that, the policies and, again, the DNA of the company is built into fairness and keeping the client in mind.
Awesome. Thank you. Thanks for those insights. Juan, we have a question for you from one of the participants. Can you talk about how you engage local communities in your processes?
Well, that's a good question, actually, because that's probably the biggest challenge, and is how you bring workload enough to have these communities involved. First thing is, when we get to the communities, we are their partner because we're bringing assets paid by utilities to bring them services. I'm telling about schools, about water hubs, and even solar mini grids or solar solutions. So first thing we do, we just hire them, and most of them, in some cases, we hire for the construction of the community, and then we found that we needed to have, and I'm going to Tuquela case in north of Guajira in Nazareth, where we needed, it was 9 hours drive off-road, and it was very difficult to solve problems, and the connection was not very good. So we have to train a couple of guys there to actually manage the microgrid, and they're still being our operators. So in most of the cases, we have a tag service app, which actually pays for the service. So they are like a kind of technical Uber service, locally sourced. So that's why we involve the community in the construction, and then in the operation, which is probably our biggest business, and they are the ones who doing the operation, the money collection, and all together. The same guys from the same community are doing the whole job.
I have a question for you. I hope this is appropriate to ask you, but you've mentioned that you've done a lot of fundraising in Europe. Do you perceive a difference in the approach to emerging markets impact investing between European and US investors?
Well, probably it's not a difference. It's just that the European market had the African experience close by, so then
Mhm.
that made them like grow that initiatives. European banks and other funds probably were the ones investing and risking in impact investing, and the American funds were very busy approach. So if you are not like hyper growing, then you are not feasible for them. But then in this impact world, you need to balance that. You cannot hyper grow and then keep profits and then keep that. So you can grow fast, but you need to keep that balance. And that didn't like a lot to the VC world, and that's probably the challenge. But now we're seeing probably impact funds led by US government or others that are actually chasing that aim. So probably it's a difference of timing, but not a difference in essence.
Yeah, that makes sense. That makes sense as a contrast to the sort of VC expectations coming from Silicon Valley over the last several years. Robert, passing it over to you, what have been the largest impediments that you face in deploying capital in emerging markets, and how have you overcome them?
Yeah, I think I can't point to like a certain moment. I think it's been a journey as how we've coped with that. I think previously we've really relied on the general partners and their expertise. And so because we didn't really know how to operate in some of these markets, and we're still learning, frankly. But what we realized is as a family office and many family offices here, you have much flexibility. You can deploy philanthropic capital, you can deploy equity, you can deploy private debt. And I think without, we all had to really rely on general partners to be able to channel that. And I think we realized that we can do more than just being a passive LP. And so once we started to build relationship locally with founders, I think that really helped us unlock a lot of ideas and therefore be more active as an investor. And so like the education financing company that I mentioned earlier, we realized that not only do they need equity for the company to grow, they need to grow their loan book, and they don't use their equity to make a loan. They raise another sort of SPV for debt. And we were able to introduce one of the funds that we were LP of to that company founder. And I think that really unlocked the growth of the company. And so I think kind of being more proximate to the founders and the students who these founders are serving, and like how the students are being served, and along that value chain, how we as a family office can help, I think something that we're learning and continuing to do. I think it's a mentality shift also. I think so far we've always viewed success of our effort as the more of outcome driven. So like, is this the most efficient solution? And I think that question is fair and it needs to be there. But we've never asked the question of like, what about the process of investing? How do we, as an impact investor, how's the process of investing different? Because we realize if the process is the same as like a normal investing, I think, it doesn't really change as an investor. I think we, as a family office, we realize we want this journey to be super joyful. And that's not something a lot of people talk about. And I think to be joyful, you need to experience the pain of the communities, right? You need to experience the issues that some of the actors, change makers are addressing. And if LPs are just like not the only exposures through annual reports, then I just don't think it's enough. And so by getting a little bit closer to the community, I think it really helped us to better understand how we can, like, first, how we can, like, what our vision can be, right? Like without seeing, you can't like come up with a vision, right, as a family. And also how we can sort of unlock all the different resources that we have. And as a family office, we have something a little bit unique than other family office, because Jeremy is such a well-known figure, especially in Asia. And so how do we leverage our brand to be an outspoken person for an issue that we care about, like mental health for founders? And so we're learning, honestly, but I think that's a very long-winded answer to your question.
That's great. I'd love if you would maybe share a little bit more on how it sounds like you've done some philosophical thinking about how impact investors should maybe show up differently than someone just investing for returns. What's another component of how that process should look different for an impact investor?
Yeah, God, this directly impacts our portfolio construction, but I think, I mentioned about serving first-time high impact potential GPs. We could serve a lot of them or choose to serve like one a year. And I think we're choosing the latter. We realize to really spend time, because I think the first-time GPs, as a lot of, like Joanna probably experienced, like you're really putting your life on the line, right? You're giving it all. Like it's a 10-year commitment, even if it's just one fund. And so if you think about psychologically what that means to the quote unquote entrepreneurs or the fund managers, there's immense pressure. And on top of that, you have to get the impact right, because the supply of the capital is constantly moving. And I realized that any family office has huge value add to these folks. And so talking to them about and inspiring them, continuing to inspire them about the missional sort of element of it is something we're paying a lot of attention to. And then honestly, it's like having simple things like having a dinner with them. It's just like when I go visit them, seeing each other more often. And I think those things, relationship building, is something we're really focusing on at this point.
That's awesome. We have another question from the participants, which I know we're pushing up on time. Like I said, each one of you could probably talk about this all night and have so many snippets of wisdom. What are the pros and cons of bucketing all emerging markets together as one investment geography versus educating investors on the nuances associated with different regions and countries? I guess that's an open question for anyone who wants to chime in.
Okay, I can take a crack at it. Or Joanna, you want to go first?
No, go ahead, Robert. Go ahead.
I think very briefly, pro of bucketing it all into one, I think it just strengthens diversification as an investor who's sort of mildly interested. If there's an investor who's like really interested in one particular market, I don't think you can take that approach, because each market, even within Southeast Asia, is so unique. I think there's a way to group them, and I think there is commonality, but there's also a cultural component that is very different. And so depending on who you're talking to, I think, both approaches work. I think it just depends on, what the investor's looking for.
Great.
Yeah.
Did you want to jump in, Joanna?
No, I mean, I think it goes, I think there's another question specific of me, and it goes on that sense that, yes, I mean, you can have an allocation strategy, right, into emerging markets, but it's also important to back GPs that do have, the understanding of the local communities and do have boots on the ground. So we definitely have that, right? We have a big team in Bangalore in India. We have a team in Mexico, and about at least, even for partners, about 20 to 30% of our time is spent time, in these local communities, understanding the clients, in addition to all the time that, and I agree with Robert, we spend just with the teams and the entrepreneurs and being a partner to them. So there are nuances, absolutely. There's also commonalities. And I think you need to kind of, build that over time. That's the reason why, for example, we haven't in Africa. There's a huge need there. Frankly, we don't have an African partner. We don't have that local need. So you keep to your strengths, basically.
One final question, if we could just go around the room. I just had another one come in. Hold on, sorry. They're all starting to come in, of course, right at the top of the hour. Yeah, great. In selecting target geographies, which factors have been most important for each of you? For example, maturity of local markets, rule of law, foreign exchange stability, your own familiarity with local markets. How have your organizations, companies, investors that you work with select target geographies?
Where we had most expertise and network. I think similar to what Joanna said is you got to rely on your strength, especially when you go into markets where there's a lot of unknowns. And so that's been our strategy.
Yeah, I mean, I would say there's a minimum of things that you require in terms of like we don't go into Venezuela, right? So take out the threshold, right? Above that threshold, again, I do think it's connections, understanding the client and the market readiness, the ecosystem of entrepreneurs. You have no idea how much the ecosystem of entrepreneurship and capital has changed in the countries that we operate. It's fascinating. India has always been a little more advanced than Latin America, but Latin America just in the past 5 years. So you're starting to see that quality of entrepreneurs that actually want to have impact, right? It's not only, and so when you start seeing that ecosystem build is when we get excited, and we are quite excited right now.
Juan Diego, anything to add?
Well, at the end of the day, the capital allocation in the emerging markets will have the risk, of course, but then you have also the upside of those markets themselves, where you can have these plus in anything. So having these kind of ideas like the regular fintech models, where you have the financial inclusion altogether, you can find that, as you were talking at the beginning, these high interest are very atypical in the US, but they are very typical in Latin America. So people is willing to take loans that seem to be very expensive in US, but they are very cheap in Latin America. So that same scenario, you can take it all beyond, and then you can cover all those risks with the high upside where you're having in the emerging markets. Because at the end of the day, there is a lot of needs to be served, and there is a lot of opportunities. In the big markets, everything is already built and everything is already in somehow coped. So I believe that the risk will be tackled with the upside you're having in each of the business you are having.
That was actually a great bow on the end of this conversation. Thank you so much to the three of you for being here with us tonight. I know that was so quick. I wish we had more time. But we appreciate your insights and wisdom, and thank you for the work that you're doing in the field. For everyone else on the call, a poll probably just popped up. So if you have a second, it would be awesome if you could fill it out. We've just started to do events at Align and love all the feedback we can get. So thanks for being here tonight, and we will see you guys soon.